Okay, so just wanted to create a video because about an hour ago, I received an email from this person named Tom where he asked a pretty interesting question. So I thought, hey, why not create a video on this? Because I think what he has asked in this email can definitely benefit you if you're new to trading options. So inside his email, he says, "Hi Davis, I'm new to options trading and came across your YouTube videos a few weeks ago and they have been tremendously helpful. Thank you. I've been binge watching your videos every day now and have learned a lot. However, I'm feeling a little overwhelmed from the sheer amount of option strategies one can trade. I prefer to learn and master one strategy at a time. I like to know whether there is one strategy that I can use for all the different market conditions." So yes, first of all, I definitely understand that it can be a little bit overwhelming, especially if you are just starting out in options trading. But definitely over time, slowly but surely, you'll be able to grasp all these concepts. So the main question down here, he says that I prefer to learn and master one strategy at a time. I like to know whether there's one strategy that I can use for all the different market conditions. And yes, there is a strategy that you can use regardless of the market conditions. And that is the topic for this video, where I call this option strategy the all seasons option strategy. So you can literally trade this option strategy regardless if it's a bull market, a bear market, or even if the market is just going sideways, because there are many different ways that you can structure it. So this option strategy is actually very flexible. And what is this option strategy? Well, it's none other than the put ratio spread. So if you've been following my channel for quite a while now, then you know that I like the put ratio spread quite a bit. I always have a put ratio spread position on inside my portfolio. And the reason is because this strategy is very versatile, very flexible. You can make it to be a very bullish structure, you can make it bearish, or you can make it neutral as well. So I've already created quite a number of videos on this put ratio spread, but for this video, I'm going to explain into a little bit more details as to why I think this can be one strategy that you can use to trade all the different market conditions. So first off, let's go over to the option chain and let us decide on the DTE to choose first. So generally for myself, I like to go for around the 45 DTE mark, because this is where our edge is. So in case you're new to trading options, you're not sure what the edge is, then just head on over to my channel and I'll put the link at the top right hand corner of this video to show you which video I'm referring to tell us what is the edge that we have in options trading. But for this video, you just need to know that we want to go somewhere around 45 DTE. So around here, you can see that the closest to 45 days would be this one, 44 days. So let me just click on this, and then we are going to expand the option chain to see what are the choices we have in terms of the strike price. Now, first of all, it's pretty important for you to analyze the strike price first before you straight away decide, hey, this is the DTE I want to go for and I'm going to just execute my trade here. No, you don't want to do that, because some of the DTEs that are available might not have the kind of proper strike price intervals that you want. For example, as you can see here, the strike price interval is about $5, somewhere near at the money. You can see it's a 615, 610, 605, and then only from this point on, there is a dollar interval. So generally, I like to see the strike price where there's $1 interval. So sometimes for some reason, there is this big dollar interval, like this one is $5 interval down here, and it makes it a little bit tougher for us to construct the trade properly, because sometimes we might want to go for somewhere in the middle to position size better, or to be able to construct to what we want. So if you see that there's like $5 intervals in some of the strike price down here, or sometimes it might even be at a lower strike price, the lower deltas, then I'd say just head on over to the next available DTE, and that would be this one. This is the 58 days. So it's definitely fine as well, as long as it's above 45 DTE and not below. Because the research based on Tasty Trade studies have shown us that our edge is 45 days and above. Anything that is below 45 days, then the edge is not really prevalent over there. So let us just use this 58 DTE and let us construct the put ratio spread. So in case you're not aware how the put ratio spread structure is, it's actually pretty simple. This is how I like to think of it. You have a short put. So in this case, let us just use one of the short put down here as an example, 600. And then you have a debit spread as well. So it will be a put debit spread. So a put debit spread, let us say we use 605 and we also use 600. So with the put ratio spread, you will notice that the put debit spread, the short leg of the put debit spread is actually sharing the same strike as the short put. So over here, I'm going to change this to 2 short puts. So let me just move my face over here so you can see it. So I'm going to change this to 2, and this is the put ratio spread over here. So let me just go down to show you how the graph actually looks like. So one thing about the put ratio spread is that there is this triangle over here. You can see this triangle shape. I call this the tent. So this tent is pretty much where you have the highest potential max profit that you can achieve. Basically, it will be at this point down here, right at the height of the tent. So for us to get the max profit, it will be at this point, but it's going to be very difficult most of the time because you need to be exactly at the short strike at expiration of this strategy in order for you to get the highest profit. Most of the time, you'll be getting lesser than the max profit, but that is fine as well. So why do I say that it is suitable for all the different market conditions? And the reason is because you can shift the strike prices around to get the kind of structure that you want to fit your view. So let's say, for example, I am very bullish on the market. So if I'm very bullish on the market, there's a few ways that I can adjust this. So the very first way that I can do is that maybe I want more credit upfront. So based on this structure over here, the credit that I can get for this is $702, as you can see on the cursor over here. That means to say, this is where the current market price is. So if the underlying that you're trading this strategy on expires above where you first put it on at the current price, then this is where you're going to make the premium on the trade, which is about $702. So let's say you want a little bit more credit if the market goes up. So what do you do in this case? So what I can do is simply just move this long put strike down here further out of the money, which is going to give us more credit up front. So let's say I'm going to move to around 602. So if I move this to 602, it will give me more credit. So first off, you will notice that, hey, it's only 43 cents. What's going on down here? I thought you said that it's going to give us more credit. Well, this is where it's very important for you to take a look at the structure to see whether you put it on correctly, because you can see that this buy down here says 2 when it's supposed to be 1. So this is where sometimes if you're using this platform, which is the Thinkorswim web platform, and somehow the number resets it, very important to make sure that you always see that the number of contracts is correct before you just send in the trade. So if I was to go back down to the graph again, you will see that the profit now is $770. So we got slightly more out of this. At the same time, if the market comes down, you also do have some slight protection in this debit spread down here. So this debit spread is not that big, it's about 2 points wide. So you get slightly more as the market comes down from this point down here, right? At least to this peak over here. So if you want to make this slightly much more defensive, then this is where you want to change the spread again. You want to change this debit spread down here to make it much more defensive. So how do I do that? So the way to do this is to increase the width of this debit spread. So if I was to adjust this put strike down here to move it to, let's say, 610. Let me see if we can go to 610. Okay, if I move it to 610, you can see that it's 2.4. So again, change this back to 1. And then now you can see it's 5.73. So let me just go back down to the graph to take a look. And you can see straight away that the tent is so much bigger. Not only is the tent now much higher, but the break even is also pushed back a little bit more as well. That means to say, if the market was to come down, then it would have to travel a little bit further compared to the structure we saw just now in order for you to get into the loss area. So this is how you can actually make it a little bit more defensive by widening the debit spread. So once you've already widened the debit spread, you notice that, hey, why is this like a little bit lower than just now? So if I was to hover over this point, you will see that now the P&L shows it's about $573 compared to just now is about $770. So why is it now that we are getting lesser as the market goes up above where the current market price is? Well, the answer is because we actually spent more on the debit spread. So remember, this structure, you can think of it as the short put. So you have the short put where you're receiving a premium and you use part of the premium to finance the purchase of this put debit spread. So in essence, you actually have two kind of opposing strategies in a sense, because the short put, as you know, is going to be pretty bullish. It's a pretty bullish strategy where we want the market to generally go up in order for the strategy to be profitable. Whereas for the put debit spread, it is a bearish strategy. We want the market to come down in order for us to profit on the put debit spread. So when you have a combination of these two, this is how you can get this structure down here. So the reason why we got lesser credit is because now we have to spend a little bit more on this put debit spread. So if I was to just change this to just 1, you will see that the debit spread costs us $2.40. So it's going to be more expensive than the debit spread which we constructed just now. So if I was to move it to 602 again, you'll see that it costs only 43 cents just now. So if we have the credit, which is around $8.12, let me just show it to you. Very simple calculation. So if you take 8.12 and minus off 0.43, compared to 8.12 minus $2.40. So naturally, this one down here, structure A, is going to give us more credit and it's going to be slightly more bullish. But structure B is going to be a little bit more defensive because now we have a wider debit spread and we're going to get lesser credit upfront because it's going to cost us more for buying this put debit spread. So that is why we can have different structures compared to what we've seen just now. So this is just the picture, or rather the P&L graph of the put debit spread. So if I change this to 2 now, you will see that now this becomes the put ratio spread. Now, the other thing you can do is actually also adjust where the short put strike is. So for this example, I actually had it around the 30 deltas. What if you're afraid that the market may have a very big move down and you want to protect your downside? Then in this case, what you can do is to just shift this short put strike all the way further down. So for this, what we can do is base it on the delta. So for example, let's say I want to base it off of the expected move. So the expected move is always somewhere around 16 delta. So I'm just going to take a look at what's the strike price for 16 delta. And you can see it's 576 and 575. So what I'm going to do is I'm just going to change this over here to 575 or 576. So let me just use 575. And this is where we have a much lower point for the put ratio spread, where the pinnacle of the 10 is going to be much lower. So if the market goes down, then it's going to be much better for us to have this structure compared to the other one just now, which is around 30 deltas. So once you've already shifted this down to 16 delta, the next thing you need to do is to adjust this long put as well, because at the moment, now we're going to have some losses to the upside because our debit spread is just way too big. So it costs more for us to put on the put debit spread than the premium that we receive. So this is where we need to adjust this. So how do we adjust this? This really comes down to what we can get. So let's say if I was to shift it to 605 and change this to 1 contract, the main important thing is I want to see a net credit upfront. So this way, even if the market goes up, then there's no risk for me. I miss out on the max profit on the 10th, but hey, at least I'm getting paid some credit for putting on this trade. So if you take a look at this, all right, at this point down here, we are still getting a debit. So we want to adjust this until finally we get some credit. So I'm going to adjust it down a little bit more. So let me use 602. Okay, there we go. So we now have a credit, although it's not that much. This is about 32 cents, which equates to $32. So this is what I call a very, very defensive structure, whereby your main goal is to try and capture the profits in this tent over here. And what you notice is that the break even now is even lower than just now. So if you're afraid that the market is going to come down, then you can put on a structure like this. Basically, you can have this also as a semi-hedge to any long stock positions that you have. So if you already have a portfolio full of stocks where you're probably holding for the long term, then this can really come in to give some sort of a semi-hedge, whereby if the market comes down, then first of all, your long stock portfolio is going to be in a drawdown. But in the meantime, while waiting for the market to eventually go back up, provided you've chosen, fundamentally good stocks, or maybe you've gone for the positive drift index ETFs, in the meantime, this can actually help you get some profit on the way down. So how much can we get once it comes inside this 10? So if I was to hover around the tent over here, at the highest point, we are getting roughly about 2,600 and I think around 60 plus dollars, which is pretty nice. Now, of course, you do not have to structure it this way. You can make it so that, hey, maybe you can get a little bit more credit upfront as well, just in case the stock doesn't actually come down and it goes up. So how do you do that? So by now, based on what I've said just now, if you've really paid attention, you know that what we should do to increase this credit that we receive upfront for putting on the structure is to reduce the size of the put debit spread. So to reduce the size of the put debit spread, we just have to shift this further down. So let's say maybe we go for 595 and there we go. We can have slightly more credit upfront and the amount is about $170. So you notice that there is a trade-off for this. If you want more credit upfront, then you have to do with a smaller tent, which means to say your max profit for this tent now is going to be lesser. And more importantly, what you notice as well is that the break even has actually moved. It has moved up. And that means to say now it's easier for you to get into the loss zone compared to just now. So this is the trade-off. If you want more credit upfront, then it means that your break-even is going to be higher and you're going to receive lesser for the max profit zone. But if you want to have a much bigger tent, let me just shift it back to the one that I used just now, I think it was 602, then you're going to have much more profits in the tent, but you have to give up the upfront credit down here. So as you can see, it is very versatile, really depends on how you want to structure it. Now, the final way that you can construct this is if you are much more neutral to bullish. So that means instead of having our short put strike so far away, we can actually shift this to at the money. So for this, let me just choose this. And this is where we are going to have our put debit spread a little bit in the money. So we have our short put down here, and then we're going to add the put debit spread. So for this put debit spread, let us use 630. And straight away, you notice that the tent, the pinnacle of this tent is right at where the current market price is. By the way, I'm using SPY as an example. You can definitely use this on any other stocks as well. So this is how you can get a little bit much more aggressive, because if you think that the market is not going to move too much, it's going to stay somewhere around the current market price at expiration, then this is where you can construct this put ratio spread at the money. In fact, I'm going to try and make the tent even bigger. Let me just extend the size of our put debit spread. So let's try with 635. So 635, you can see that the tent is much bigger now. Let me just show it to you. Let me mark the break-even price, and you can take a look at the tent here. What if I want a much bigger tent again? Because now the upfront credit is still quite a bit, which means to say I can make this tent even bigger. So let me try 640 and see what we can get. There we go. You can see that the tent right now is bigger, break-even is pushed further back, and our max profit is increased as well. Now, finally, not only can you use this on stocks or index ETFs, but you can actually also use it on XSP. By the way, if you like this video so far, please subscribe and also click the thumbs up button. And also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So XSP is the cash settled index options for the S&P 500. And this is very good if you do not want to get assigned any shares whatsoever, because there is no assignment of shares and there is no early assignment. So you can hold the trade all the way to expiration, and it is actually very helpful for the put ratio spread, because the put ratio spread is what I call a very slow spread. So let me just show you what I mean over here. So let me just construct the put ratio spread again for you to see, and I'll explain to you why it's considered a slow spread. So this is the P&L graph for the put ratio spread. So you will notice that there is actually another line on top of this line down here. So this line, this triangle, this tent over here is at expiration. So for example, if the price is over here at expiration, then you will get the max profit of this whole trade. However, it takes a long time for this tent to actually mature, right, so to speak. That means to say, if 1 week after you put it on and the market actually comes down to this point, guess what? You're actually not getting this profit, and you very possibly might still be in a loss. And the reason is because of this line over here. If you can see this blue dotted line that I am just trying my best to draw over it. So this blue dotted line is where the current P&L graph is. So when we trade options, it's very important to understand that we do not immediately get this P&L graph the moment we put it on. This is only if we hold the trade all the way to expiration, then we can get this whole structure here. But before it actually gets there, it's this blue line down here. So over time, this blue line will eventually gravitate upwards to form this final P&L graph at expiration. And for the put ratio spread, this takes a very long time. And it's usually only around expiration date that this blue line is very close to where the P&L is at expiration. So let me just show it to you. So let's just say about a week out from today, when we first put on the trade, the market actually goes down to where this tip of this tent is. So let me just remove all this drawing so we can see it a little bit clearer. So let me just mark this point down here. And I want you to pay attention to this blue line down here, which I'm going to try my best to draw across again. Okay, so over here is the calendar. So I'm going to show you how it's going to be like just 1 week later. So today, this is where the blue line is. That means to say, if the price was to go down immediately today, and it comes down to where our short put is at this point over here, we're going to be in a loss because the blue line is still below the zero mark. So let me just remove this again just to show you how much the loss is going to be. So if you see this blue dotted line, I want you to take a look at this figure down here, this number here. So if I was to hover over to this price down here, you will see that the loss is at 597. So we're going to be at a loss of $597 if the market comes down to where our short put is today. What about 1 week later? So let me just click on this calendar over here and let me fast forward to just 1 week later. So 1 week later, you notice that the blue line has indeed moved up, but not by much. We are still in a loss, although we're losing slightly lesser now. So if I was to hover over the same point again, you will see that the loss now is $489, which is slightly lesser compared to the 500 plus loss which we had just now. Now let's try and move it 1 month in advance. So from July, let us move it to August, maybe somewhere around here. So this will be 1 month. So you notice 1 month later, the P&L graph, the blue color dotted line, has indeed moved up, but we are still not near the P&L at expiration at all. It's still very far away. So the DTE that we have chosen for this is 51 days. And 30 days have already gone past. 30 days of 51 days, that's more than half, but we have not even moved halfway to where the P&L at expiration is. It takes a very long time. As you can see, very slowly this blue line finally goes back up. So let us try and shift up even closer to where the expiration is. So the expiration is 23rd. So let us take a look at how it's going to be like about a week just before the expiration. So that will be around, I would say, let's just choose 16th of August. Okay, so now the blue line is making some progress. As you can see, it's now inside the tent where we're going to at least have some profit. But you notice it's still not even half the profit of the max profit point. The max profit point is somewhere around here, and this is where we're currently at. And quite a number of days have gone past already. If there's only 1 week left, it just means that about 40 plus days have gone, and we're not even at the halfway mark. So as you can see, it's not that proportional. It's not like, oh, there's a half of the remaining time left, so I should be getting to the point where the P&L graph is going to be halfway to the P&L expiration. No, it's not like that. If I was to go to somewhere around halfway mark, which is maybe somewhere much earlier, maybe let's choose the 1st of August, you can see that it's so much further away. It's not even halfway there. It's only towards the last few days that we're going to get there. So let me just remove all this drawing again, and let us take a look at where it is just, let's say, 3 days before the expiration. So 3 days before the expiration, then this is where we can have it very close to where the expiration line is, but still not nearly there yet. Okay, so if you want to put on the put ratio spread on the XSP, which is the cash settled index option, or any other cash settled index option, it's very important to understand that this P&L graph down here will only realize at expiration. That is why you can't say that, hey, can I immediately take off the trade if the market just comes down to this point and immediately take the profit so that it never gets into this point down here? And the answer is, of course, ideally we want that to happen, but it just doesn't work that way for options. So let me just show it to you one more time so that you can be very clear. So imagine we go back to the starting point, and let's put maybe about 2 or 3 weeks in. So maybe somewhere around 22nd. So this is where the market might have come down to the point where it's at the pinnacle, the tip of the tent, where we're supposed to get the max profit expiration. But at this point, we cannot close the trade just yet. Why? Because we are in a loss at this point over here. If I was to hover over the price, you will see that the loss is still at $221. So it doesn't work whereby you close it now thinking that, hey, I will never let this go past to the loss point, because we do not have control over that. Only over time, this will eventually go up. Then you can have a chance for us to get this profit inside this tent over here. All right, so this is the put ratio spread in a nutshell. So again, if there's just one strategy that you want to focus on, regardless of the market condition, be it bullish, bearish, or if the market is going sideways, then this is the one strategy that you can definitely use to put it on, which is the put ratio spread. Hopefully this video has been helpful for you. And if it has, I would greatly appreciate if you give me a thumbs up on this video, and also subscribe to my channel for more options trading videos like this. And I will see you in the next video.